makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Paris with the conversations that matter, and here's what's coming up on today's program. Bloomberg reveals Apple is ditching efforts to build an electric car and switching its focus to AI and mixed reality headsets. The European Commission president says Ukraine's allies should consider using profits from frozen Russian assets to buy weapons for Kyiv, warning Europe must prepare for the risk of a wider war. Plus, congressional leaders meet President Biden as efforts to avoid another U.S. government shutdown ramp up. So good morning, everyone. Let's take a look at the European markets map. We also have a full focus on banking in Paris. We're launching our newsletter today, and I hosted a great event with some of the top bankers to talk about also increasing headcount in the country. Now, European stocks for the moment, a little bit of a struggle to get traction. U.S. futures also slipping. Again, traders bracing for a lot of economic data in the second half of the week. That will help determine the path of monetary policy. And of course, in terms of the actual stocks we watch, we look at Apple and Klarna, who's potentially looking at an IPO in the U.S. Now, let's bring in Bloomberg's Noor Al-Ali to talk about the markets. Noor, a lot of the focus still on that data coming, of course, from the U.S. a little bit later on. I think there's also the preferred indicator of the Fed to look at inflation. What are you looking at today?
Yeah, absolutely, Francine. And you do see that rates traders are actually starting to succumb to the idea that perhaps the Fed was onto something with their dot plot. And now you're seeing that they're actually betting of Fed rate cuts of about 325 basis points cuts, so that puts it around 75. It's pretty much in line with the dot plot. We've had some reporting overnight on that, and you're starting to also see, that bond bull market really seep into the idea. We've got, we had the New Zealand central bank news earlier today as well, less hawkish than expected. That dovish tilt that's starting to kind of feed into the idea or add to the idea that perhaps that bonds now, they could be getting that bullish momentum that we've been waiting for quite some time now.
So, Noor, is there anything else? I know there's been a lot of talk, of course, of Japanese equities, some contrarians, and actually what Japan will do next. Is there anything outside what we talk day in, day out that we should keep an eye on?
Yeah, absolutely. Look, I think with the yen here, and concerns about speculation that the Bank of Japan is going to raise rates is definitely going to get that yen in a direction that potentially may not be favorable for stocks. But, as you've heard from Mark Cudmore recently in the other shows, perhaps even yesterday, you'll see that Japanese stocks are really rallying. If you look at, and I did this amazing chart today that looked at all stocks performances globally since COVID, so since that dip that we've seen in 2020, and you'll see, in fact, that Japanese stocks, along with the U.S., even though now Japanese have outperformed recently, have really been star outperformers relative to pretty much everywhere else in the world. If you look at China, though, however, they've really lagged and they've really underperformed. So you can see that the story there is shifting for Japan. Obviously, U.S. stocks have been rallying on that tech on that tech rally and that feed. And now with speculation of us pushing back those Fed rate cuts and the dollar being surging, I think there's potentially room for a pullback. But the idea of momentum is still very much there for stocks. And it feels like it'll be a fool's errand to go against that right now.
Noor, thank you so much. Noor Al-Ali there from our markets team. Now let's continue talking about the markets. We're also joined by Vincent Juvyns, global market strategist at JPMorgan Asset Management. Vincent, thank you so much for joining us today. It does feel like a big week towards the end of the week in terms of data points that we're getting from the U.S. Apart from, growth of inflation, do you have a metric to look at to see whether, first of all, growth continues in the U.S. and whether a soft landing is definitely a given?
Well, the US is all about the US consumer, obviously, since it accounts for 70% of GDP. So it's clearly the health of consumer balance sheet that we're still monitoring almost on a daily basis. You see the health of the job market, which obviously support income growth in the US. Inflation is an important parameter as well. We're now seeing that in the West, in the US, in Europe, you have finally wage growth outpacing inflation. So clearly, this provides a boost to purchasing power. This should obviously continue to support consumption. In the US, there's another element which has supported growth quite meaningfully over the last couple of years. It's obviously fiscal policy. In an election year, we would expect obviously no major change to the fiscal policy, but the fiscal stance will inevitably in 2025 and beyond probably become less supportive. But to your question, clearly, U.S. consumption remain by far, obviously, the most important element to assess the health of the U.S. economy.
Vincent, I mean, there's a lot of questions about the labor market, and of course, we'll look at the dot plots to try and give us an indication of how quickly or how far the Fed can start cutting rates. It's very clear, well, at least for now, it's very clear that the next move is probably a cut. But how do you navigate the markets in this environment?
Well, I must say that the market expectations since the beginning of the year have become a bit more realistic. We were a bit surprised by the Fed pivot in December to pre-committing to 3 rate cuts for this year, which the market interpreted at 7 or 8 rate cuts, obviously, which was back then a bit exaggerated, obviously. Now we're looking at market really expecting something like 3-4 rate cuts in the second part of the year, which in our view is more realistic given the economic backdrop that I've just described. So from a market perspective, I think that the market movements in the beginning of the year have been more healthy in a sense. It's not anymore built on the expectation that we will have massive rate cut later this year. I heard you discussing fixed income market. It's clearly an environment where, again, I believe it's really time to push cash at work and come back on fixed income market when 10-year yields dropped to 3.8 at the end of last year. This was probably a bit too fast, too low, and now we have recreated some value again, not only for sovereign bond and in terms of duration, but credit market at the moment, and not only in the US, but are really the place to be in the current environment. And rate cut will come, probably not as fast and as much as expected at the end of last year or the start of this year, but it will be enough, obviously, to provide a massive tailwind to the fixed income asset class.
Yeah, is there a danger that actually if cuts don't come sooner rather than later, then it counts like a policy mistake, and that's when you start some of the labor market dynamics and some of the economy unraveling?
Well, at the moment, you continue to see inflation trending down with hiccup underway, which we expect, obviously, but we are still looking at both in the US and Europe inflation getting close to 2% by year end. So clearly an environment where the central bank can deliver those rate cuts. I would say for fixed income market, whether we have 3 or 4 rate cuts won't make a major difference. If you enter this market at the moment, only for the carry you get already on credit market and in terms of duration, it's worth considering. And you know that ultimately later this year, maybe at the start of 2025, you will have these rate cuts coming, which will provide on top of this nice carry that you have at the moment, decent capital gain. So the story is the same this year, and it has been after every, let's say, end of tightening cycle in the US and globally. Once the Fed and central banks stop to hike rate, it is a perfect environment to push cat at work, certainly in fixed income market and to some extent on equity market. And we have seen this again since the start of the year.
Vincent, what's your take on earnings so far? I know 2023, there were a lot of forecasts going into the year of lower returns or certainly lower margins. It seems to have been a pretty good crop in terms of earnings overall, but there's this difference between if you do well and you give back to shareholders, then you're okay. But if you disappoint, you really get slammed in the markets.
Yeah, clearly. And when I say that, I think that the market movements since the beginning of the year are healthier, certainly in the rate expectation. They're also healthier because they're really this performance is based on good earnings foundation. So last year we saw that especially US equity market was almost priced for perfection, given this AI boom, the tech, the concentration within tech that we've seen last year. We've seen that those tech companies have really delivered on promise. Really, you've seen strong earnings growth from that part of the market. And as you mentioned, also tech companies also increasing their dividend, increasing their share buyback program and so on. And it's a very central theme that we have at JPMorgan Asset Management globally, the ability of corporate to hand over cash to shareholder, either in buybacks or in dividends. Clearly, the dividend theme is one global theme, which is to us very attractive in the current environment. We've seen historically that at the end of a tightening cycle, dividend equities tend to do well. You find them in the US, a bit more in Europe, and you find them more and more in Japan. Japan is clearly a market where you see this reform of corporate governance leading to a higher handover of cash to shareholders. So this is really an overarching theme, I would say. So earnings season was clearly good in the US, thanks obviously to tech sector, a bit less encouraging in Europe, where obviously it's a bit more dispersed. You have a bit less. We don't have tech obviously in Europe. Healthcare was quite good so far, but it's fair to say that it's hard for European equities to outgrow US equities at the moment.
So, Vincent, if you look, though, at a part of the market, and I'm thinking of the Magnificent Seven, but also a part of the tech in general, it does seem priced to perfection. What will be the support to some of these valuations going forward?
Well, as long as they continue to deliver on the earnings front like they've done so far last year, I believe we should continue to remain exposed to this sector. We should look at the impact of AI beyond the tech sector. AI will be disruptive for plenty of sectors, including our own sector. At JPMorgan Asset Management, on our investment platform, we use AI to help us managing our funds on behalf of our clients. It will be important also in the healthcare sector. It is going to be disruptive in many sectors. So it's our role as asset manager to identify which are the sectors which are going to benefit from it in the future. To speak obviously about your sector, the media sector rely already a lot on AI since many years in terms of production of content and so on. So clearly this technology is disruptive and it's an investment theme, which is a long-term investment theme, as I would describe, which we need to capture as an asset manager.
Yeah, no AI on the pulse, Vincent. You're absolutely right that the trend for media has been going that way. Vincent Juvyns, global market strategist at JPMorgan Asset Management, joining us, of course, to talk about the markets. Now, coming up, why have the biggest banks on Wall Street been ramping up their staff numbers in Paris? We'll discuss that next, and this is Bloomberg. Now, the heads of major U.S. banks in France, including Morgan Stanley, Citigroup, JPMorgan, and Goldman Sachs, say Paris is the new trading hub in continental Europe since Brexit. Now, speaking in our Paris bureau, they said the pool of talent and new political measures have really boosted the profile of France despite high labor costs.
Paris for us is a hub. Clearly, it's our continental Europe hub. We've grown from 250 employees to more than 900 now.
We had 170 people before Brexit. Now we are more than 400, and we have extended the office, opened a second trading floor to be able to cope up to 600 without having to move again.
A lot of things have happened already, and that's why we have 400 people on the ground today, and we will probably continue to grow, but at a different space.
In the end, we will have tripled our headcount in Paris between before and post-Brexit. And we feel that this may go further in the future.
What really made the difference is President Macron, the measure he took to make France more attractive. And also, in my view, what really made the difference more than anything else was the pool of talent.
The mathematics, French school, etc., is actually looked at from everywhere in the world as something that has momentum.
Where I'm the most challenged is it's on the overall labor cost in France.
The labor market is complicated in France. Having more flexibility is something that is important to all of us. And when you grow headcounts in an important way, it becomes more and more important.
We are a cyclical industry, and that we need to be able to be flexible on headcounts.
You need to tell the juniors, the graduates, if you want to have an international career, you can go to London, you can go to New York, but you can also go to Paris, because Paris is becoming much more international now.
Well, the heads of these major U.S. banks in France were speaking, of course, an event organized by us here in the Paris Bureau. That's why I'm here to promote our Paris newsletter. Subscribe to the website, subscribe to the newsletter. It's really great fun. Our Lionel Laurent, who's also then interviewing a regulator, was there, and it's worth it to understand the dynamics that if you don't live in the country, sometimes you miss. Now, let's also bring in our city editor, Catherine Griffiths, who's been following the UK post-Brexit finance and story regulation. So, Catherine, thank you for joining us. I mean, it was interesting seeing it from the French point of view, because a lot of the Parisian, I guess, chief executives of some of these big, hubs of Wall Street banks were saying they also need to convince their guys back home. So the chief executive, Jane Fraser's of this world, and of course, the Ted Picks, that they need more headcount because it's so difficult to get rid of people, and they're so much more costly because of everything that goes with it. So who currently has the upper hand when it comes to Paris and London?
Gosh, I think probably London still has the upper hand, but we've seen all these trends, certainly lots of jobs moving to Paris, but in overall numbers still quite small. But then I think increasingly actually people are coming up against this point about the labour laws. So as some of your people that you interviewed have just demonstrated, banking is a cyclical business, finance is a cyclical business, and people get paid a lot of money. And so the way those institutions work, they need to be able to lay off people when needed. And those people pop up somewhere else. But the laws in France are prohibitive to people being able to do that. The severance pay is just enormous in comparison to places like, say, London or New York.
So Catherine, again, to what extent is the labour law, so nothing really to do with finance, that's holding Paris back?
Yeah, I think, so I suppose there's a sense of hub, isn't there? Just as London's huge value is the things it brings together here, the law and the professional services, and also all the banks and the asset managers and all the rest of it. And that's the kind of hugely precious thing. And Paris understands that, everyone understands that around the world, this nature of hubs being so valuable, and is trying to create one. But one important slice is the labour laws. It's so key, particularly when you're in an industry where people get paid lots of money.
And Catherine, some of the banking executives here at the event yesterday were also complimenting Emmanuel Macron's policies. I remember he talked about, rolling the red carpet, rolling out the red carpet for a lot of financiers and financial services companies to come to Paris. How does the UK government compare?
Yeah, I think the UK government doesn't compare terribly favourably, at least sort of in the sort of world of kind of anecdotes that pop up about this. So banks feel very pleased with the engagement from Macron personally and from sort of senior emissaries he's sent over to London to kind of engage with senior bankers, particularly some of the US banks, come over to Paris and we're listening. What is your laundry list of things that are important to you? And they feel that they kind of convey these messages and they get sort of conveyed to the Trésor and they're actioned, or at least they're listened to, and there's a sort of sense of efficiency. I think in the last few years, people have felt frustrated here in London that UK politics have been so tumultuous. I mean, they have in France too, to an extent, but there is certainly a sense that people aren't really listening in the UK government, or haven't been. Maybe there's a sense actually, perhaps in the last year or so, that it's improved, but also a sense that of people being jaded and weary of not being listened to in the years after the Brexit vote.
Catherine, thank you so much. Our city editor there, Catherine Griffith. Now, we'll have plenty more, of course, on this story. Also, Bloomberg understands that Apple has abandoned its decade-long effort to build an electric car. So we'll have more on our Bloomberg Scoop next. This is Bloomberg. Now, Bloomberg understands that Apple has abandoned its decade-long effort to build an electric car. It's to shift some of the team's 2,000 staff to its generative AI division. Now, for more on all of this, we're joined by Bloomberg's Alex Webb. Alex, good morning. So how did we actually get here?
It's really been a decade of fits and starts. They started this project back in 2014 under the slightly ominous name Project Titan. Of course, it's elicited plenty of Titanic metaphors as a consequence. When I was reporting on Apple's bank from San Francisco back in 2016, that's when they first tamped back their ambitions in the space, realizing that it was actually pretty complicated to make a car. Over time, they then tamped it back. They decided they weren't going to build a car, but they were going to build autonomous driving systems. Then they saw how Tesla went sort of stratospheric, and they said, actually, no, we are going to, well, they didn't say, but internally they decided they are going to build a car. Finally, though, with the slowing of the electric vehicle market over the past few months, over the past year or so, it seems as though that's driven some of the decision making here. The crucial thing, of course, is the one time that Tim Cook spoke about his company's automotive ambitions on the record, he said they saw self-driving cars as the greatest AI challenge. Well, of course, now we're in a very different environment for artificial intelligence. There are a lot of very, very big AI brains working on Apple's self-driving vehicle. Moving those people to other AI applications may be more beneficial for Apple's core business, which is, of course, selling iPhones.
Alex, thank you so much. As always, Alex Webb, of course, will join us throughout the day to also understand how big a blow to the EV world and to Apple this is. Now, coming up, we'll talk insurance and AI. We'll be joined by Mario Greco, the chief executive of Zurich Insurance, to take a look at how AI is also changing the insurance industry. That's coming up shortly, and this is Bloomberg. Now, Bloomberg reveals that Apple is ditching efforts to build an electric car and switching its focus to AI and mixed reality headsets. The European Commission president says Ukraine's allies should consider using profits from frozen Russian assets to buy weapons for Kyiv, warning Europe must prepare for the risk of a wider war. Plus, congressional leaders meet President Biden as efforts to avoid another U.S. government shutdown ramp up. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Paris. So artificial intelligence is bringing about sweeping changes across industries, and of course the technology redefines how business function and speak to clients. The insurance sector, for example, is facing a pretty big change through digitization and customer-facing, but also back-end channels. In the last 3 years, Zurich Insurance has invested over $1.8 billion in technology. Now, for more on this and the wider industry, I'm delighted to be joined by Mario Greco, the chief executive of Zurich. Mario, as always, thank you so much for giving us a little bit of your busy schedule to help us understand the insurance world. When you look at AI, I know this could be facing, for example, cybersecurity, but it's also how you speak to clients to capitalize on some of the relationships. Where do you see the use of AI actually ending?
The great majority today of our investments in AI is on customer-facing initiatives, solutions. We use AI to deliver better services to customers, to understand the risks better, and to improve the customer satisfaction. Of course, the issue with AI is where will AI go and what dangerous threats will AI create over time. But at the moment, AI is an incredible benefit for us for customer satisfaction and customer developments. And that's the reason we're investing so heavily into it, both in technology and in people.
Mario, there's, of course, a large number of the population worldwide that is still not insured. Can AI also help with this insurance gap, as it were, by making it more affordable?
Yeah, one thing, Francine, that I'd like to clarify on this is, because often I hear discussions on gap of protection and climate. I don't see that. I think people find opportunities to insure themselves for climate. It could be expensive, but it's out there. There are other forms of insurance for pensions, for health, for cyber, which are really not there. And this is where we, as an industry, and the governments, and the association, the stakeholders, have to find solutions for. Because there are reasons why these kind of risks are not insured today. And I don't think AI will help in finding the solutions. I think we need a different approach from governments, from stakeholders, in allowing the solutions to be available to people.
And this is a really interesting, of course, topic that also, I guess, touches generative AI. I don't know whether there are things because of climate change, but also because of our use of AI that you see becoming more insurable. Are there products or events that you think going forward will be much more harder to insure?
I don't think they will become harder. I think they will become more expensive. And I don't think, honestly, that this price differential is unfair, because what's happening through AI, through digital, through computer, is that we understand better the individual risk that some factories, some plants, or some houses, or some specific installations and locations represent, which means that all the other people will pay less because they're not subsidizing these risks. And so it targets the riskiness to individual risk elements, which again, it is fair. Now, what to do sometimes will need some social solutions, because some risks could just become excessively priced and too expensive. And then we need to figure out what to do. A lot of this also, it's about prevention. And we've been investing a lot on working with the customers on prevention. This has been the highest growth part of our business over the last 4 or 5 years. And we continue to invest on the team of people who do prevention with our clients.
Are targets for net zero that the world has set itself still achievable, or do we need to get ready for a world where temperatures have risen by 1.5% or 1.5 centigrades? And what does that mean for the insurance sector?
I think we're already in the situation that you described. I think the world is already warmer. I think we are already there. And I think we need to face the consequences of this, which makes prevention so important. And it means also working very, quickly and dynamically with all the people to minimize the impact. I'm very concerned about heating. We've been working with a number of big cities on what to do about heating of their cities and then the impact on their citizens. I'm very concerned about water shortage and availability of water. And these are all the things that we are keen to work with, mayor, with organizations, with governments, with individuals. We're already in that scenario.
So, do you worry that the risks? There are more risks of U.S. social inflation keeping on rising, and of course, this is a term that describes insurers' claim costs that are increasing above the economic inflation.
Yeah, but not that much, honestly. I mean, social inflation has been there forever. It goes up and down. It changes depending on the years. And we're never going to get rid of it. I don't see today this as a major threat to the insurance results. In our books, we have a relatively limited impact because we have shrunk casualty exposure, which is where social inflation manifests itself over the past years. So I see it, but I don't think that for us or for the industry, this is the biggest risk over the next years.
Mario, as of course one of the most important chief executives of one of the largest insurance companies, what keeps you up at night? What are you worried about the most?
Look, if I look back and if I think about the last 3 years, what should have been worrying me 3 years ago were the potential for a pandemic, the potential for a war in Europe, the potential for a war near to Europe, the potential for a recession, the potential for high inflation. Luckily, I did not see any of these things coming, and so I slept quite well. But this is what, if I wake up in the night, I keep thinking about what am I missing seeing, what I have not yet understood that it's coming on us. It is the unforeseen, the unexpected that really a company as big as we are, tries to anticipate everything, but we did not anticipate any of these things that I just mentioned. And this is really what keeps me awake at night.
You had a good set of results and you gave back to shareholders. Is there a danger that, and this is not only Zurich, but your industry at large, financial services at large, are in a race to give back to shareholders, which is very much appreciated if you're a shareholder, but that means you're taking away capital from natural investments that maybe need doing?
We're very mindful of what you say, and we consider that continuously. In our case, we have a business model which is run for cash. We want to create continuous cash. And so we think it's fair to give back a portion of this cash each year, which for us is 75% of what we create in profits each year. We want to give it back to shareholders. This is our commitment. But we keep investing heavily each year on developments like digital. We keep investing on the skills of our people. One of the things I'm very happy is about the growth of the skills of our colleagues around the world over the past years. We have kept growing the base of our employees. So we take a long-term view on everything we do. And with that, I think that our distribution policies are healthy, sustainable, and wise. But I understand what you mean, and we're very, very mindful and careful on that.
Mario Greco, as always, thank you so much for joining us in London today, the Chief Executive of Zurich Insurance. Now, let's bring you also some breaking corporate news that just crossed the Bloomberg terminal. Bloomberg understands that KKR is exploring options, including selling its controlling stake in India's JB Chemicals and Pharmaceuticals amid interest from potential buyers. Shares of the company, which is known as JB Pharma, have climbed 68% in the past 12 months, valuing the firm at just over $3 billion. Now, coming up, we talk U.S. politics as a deadline for avoiding another partial shutdown approaches. And in another bout of deja vu, we also discuss the Michigan primary results and what that means for a Biden-Trump rematch. That's next, and this is Bloomberg.
The threat of war may not be imminent, but it is not impossible. And the risks of war should not be overblown, but they should be prepared for. And that starts with the urgent need to rebuild, replenish, and modernize member states' armed forces.
Well, that was the European Commission President, Ursula von der Leyen, speaking this morning at the European Parliament in Strasbourg on European security and defense. Now, to discuss European and U.S. politics, we're also joined by Bloomberg's EMEA News Director, Ros Matheson. Ros, thank you as always, because I know you're very busy, but I always love your analysis on trying to understand what comes next. How significant are these comments on defense from von der Leyen, also after what we heard from Emmanuel Macron a couple of days ago?
Well, it's just interesting to see European leaders much more vocal, talking out loud what they were probably thinking for some years. And that's that Europe really, for decades, neglected its own defense, probably relied a bit too much just on the fact that NATO existed, collective defense, this umbrella of deterrence, while not supporting their domestic defense industries, not building their own equipment. And certainly we've seen that show up in the shortages now that many countries in Europe are facing because they've sent so much equipment over to Ukraine in its war against Russia. So a real realization that a fundamental shift needs to happen here. The question is how? How do they get energy back into their domestic defense sectors? How do they get the equipment that they need? And how can they work collectively more than just using the idea of NATO itself in future defense? Because the question is, with Russia succeeding more on the ground in Ukraine in the longer term, what are Vladimir Putin's goals when it comes to the rest of Europe?
So to U.S. politics, congressional leaders have also expressed confidence in trying to find a way forward and avoiding this partial government shutdown. What if they don't?
Well, that's the question if they don't. I mean, they're talking more positively after that meeting yesterday involving U.S. President Joe Biden, but they are running the clock on this to avoid a partial government shutdown. And we've been here before, 3 or 4 times already in recent times with Republicans, hardline Republicans holding up these deals in Congress. If they don't get it, the immediate economic impact won't be massive, and it could be made up over time as they get backdated wages and so on. But it has, of course, unnerved ratings agencies in the past, so markets will be watching that closely. But what it really tells us is the state of politics right now in the US, the climate in Congress. Almost nothing can get done. It's not just this government shutdown that's being held up, but obviously also a big package of aid for Ukraine, some aid for Israel, the question of the border with Mexico and migrants. All those packages are sitting stuck in Congress at the moment because we're in the election cycle there. Republicans have their positions, Democrats have their positions, and no one seems willing to reach a deal.
So meanwhile, both Trump and Biden claimed victory in their party's Michigan primaries. What do these results actually tell us about the mood around President Biden?
Well, it's interesting because obviously Joe Biden and Donald Trump had a fairly clear path to victory in Michigan from the results we've seen. But we did see around almost 15% of Democrats, they decided to go for non-committed in Michigan, which was really a protest against Joe Biden for his handling of what has been the relationship with Israel for its war against Hamas in Gaza, and this growing concern, obviously, about the civilian casualties that we've seen in Gaza. And Michigan has a large Arab population, and they were obviously voting with their feet there. But it also just points to that broader question that not all Democrats see Joe Biden as the best candidate for them come November. Obviously, he is the main candidate being the sitting president, but there are those reservations about him around his age, around his capacity, and also around his policies, including his handling of this conflict. So it was interesting to see just how significant that level was.
Roz, thank you so much. Our Bloomberg EMEA News Director, Roz Matheson. Now, of course, we'll continue keeping a very close eye on U.S. politics and a possible government shutdown. To Nigeria, also, and the country's central bank has delivered a jumbo rate hike to tackle runaway inflation and stem the collapse in the country's currency. We're now joined by Bloomberg's Ondiro Ganga in Kigali. Ondiro, just how bad is Nigeria's inflation crisis?
It really is, because the cost of basic goods and services are skyrocketing. Inflation is at 29.9%, with food inflation at 35.4%. And the trickle-down effect is Nigerians cannot afford to put a plate of jollof on the table because the cost of rice per kilogram has increased 98%, onions 97%, tomatoes 81%, in a country where 40% live below the poverty line. And in acknowledging this, the central bank governor Olayemi had also attributed it to high cost of energy. He also pointed a finger of blame at insecurity in food-producing regions and also pass-through effects of the exchange rate. This explains why we saw that jumbo rate hike to try and mop up excess liquidity, also to try and ensure that they bring down inflation, manage the volatility of the currency. But until that happens, Nigerians will be out in the streets continuing to protest the high cost of living.
Thank you so much, Ondiro Oganga, there on the very latest, of course, in Nigeria. Coming up, Macy says its plans to close almost a third of its U.S. locations. Well, we have the details next, and this is Bloomberg.
Fashion, as quick as it is to change, like in the kind of aesthetic, it's very difficult to change a system, right? And I think that that comes down to who makes decisions. And the people that make decisions in fashion don't typically look like me. They aren't typically women all the time. When we look at who's at the helm of the biggest high street players, it tends to be the same type of people. And so I honestly think there's a lot of work to be done. Progress has definitely happened, but you only have to look at the last New York Fashion Week, which is the biggest and the most commercial, to see that, there's so much tokenism around what inclusivity really means. And I think that, especially when it comes to size, we're back where we were 20 or 30 years ago when you'd have one single black model that would walk down the catwalk. Now we're in that same situation where, I can't remember the stat, but I think it's less than 3% of models that came down the catwalk were above a size 12. I mean, a size 12 is like less than average. And so there's just so much work to be done there. And it almost size is the last allowed taboo.
Well, that was Emma Greed, the chief executive and co-founder of the inclusive fashion brand Good American. She's also the founding partner of shapewear label Skims, which was valued at $4 billion last year. Now, you can see that full interview on Leaders with Lacqua at 9:30 p.m. in New York today. And then tomorrow it's at 6:30 p.m. in London. We discuss her rise to the top, how she measures success, and why diversity remains elusive in the world of fashion. So you don't want to miss it. She was really an inspiring conversation. Now, some big retail news out of the U.S. as Macy's says it plans to close almost a third of its U.S. locations. That's as the department store chain tries to fight off a pair of activist firms seeking to buy the company. Meanwhile, Lowe's says its sales will fall further this year as consumers continue to hold off from sprucing up their homes amid higher mortgage rates. Now let's go now to Bloomberg's Dasha Afanyasava. Dasha, thank you for joining us. So Macy's and Lowe's, neither painting a very positive picture in the U.S. Is there any reason to be positive?
That's right. It's not looking great, but I guess they're very different situations. So in Macy's case, it is trying to make the case that it's better off as a retailer in the long term with its physical stores. And it's trying to kind of bridge that gap between the valuation, the enormous up to $8 billion valuation of its real estate assets, and then, you know, where it's trading on the market. And in this way, fight the very aggressive effort to take it over by Arkhouse. But I think in terms of the consumer, I think in Lowe we see that there's just a lot of uncertainty. And I think in the past, when interest rates have been high, people would actually renovate their homes instead of moving. Now it seems like you're not even seeing that. People are extremely cautious, and that caution is expected to extend into this year, where it's also expected to see declines.
So the consumer goods company and Eurofin manufacturer Reckitt also missed sales estimates. It's now forecasting weaker growth. What does this tell us about Europe's consumer landscape?
Absolutely. I mean, I think with Reckitt, the incredible thing is that so many different things went wrong. And I think it's got all of these external factors, particularly in the US. It's got an issue with coming off that boom that it experienced because of formula shortages. So its formula was in very high demand. But now it's dealing with increased regulation in that market. It had an early cold and flu season back in 2022, which has, you know, made 2023 look weaker. So all of these things were happening at the same time. But I think fundamentally what it's seeing is that price rises are coming off, but volumes are continuing to fall. It's the more extreme version of what other consumer goods groups are grappling with, because they are actually beginning to turn things around and volume to come back to growth. But Reckitt, because of this plethora of issues, including there's also the Middle East, where revenue was lower than expected because local staff were misrepresenting it even. So there's all of these different issues, but also consumer issues underlying them.
Dasha, thank you so much. As always, Dasha Afanyaseva. Now, coming up, we'll have plenty more, of course, from Paris. Also, be sure to subscribe to our new Paris edition newsletter. That's why we're in Paris today. All details on your screen. We can also send you a QR code. Up next, Bloomberg Brief.